Hello and welcome to this video on the terms of trade. So this video we're going to look at this concept, the terms of trade. Now this follows on from previously where we looked at the magical theory of comparative advantage. So we looked at some production possibilities between the UK and China, which gave us PPFs. And we saw that if countries did not specialize in trade, they would consume halfway along their PPFs, spending half a day on producing each good. So they would be at this position here, consuming these quantities. But if they were to specialize in trade in the product in which they had the comparative advantage, both countries could achieve positions outside of their PPFs. Now, the theory of the terms of trade is kind of the however. It's a comparative advantage says, yes, countries could benefit, but the terms of trade dictates whether countries actually will. So we said that comparative advantage exists where the country has the lowest opportunity cost. So the UK, when it made a car, is sacrificing a quarter loaf of bread. And when China is making a loaf of bread, it's sacrificing 2 cars. Now, countries will only be better off if they specialize, if they can, in exchange for what they're producing, receive something that's better than what they could have done. So the UK and China will only benefit if they receive a sufficient number of the other good in return. So for example, the UK are producing cars and they're exchanging them for bread. But remember, the UK could have, instead of producing that car, they could have had a quarter of a loaf of bread. So in order for the UK to be better off, they wanted to receive more than a quarter of a loaf of bread from China for each car that they trade with them. From China's perspective, they are making loaves of bread. Now remember, when they choose to make a loaf of bread, they could instead have made 2 cars. So if they're going to make a loaf of bread and send it to the UK, they're going to need to receive more than 2 cars for them to be better off than what they could have done themselves. And these ratios, 1 car for a quarter of a loaf of bread and 1 loaf of bread for 2 cars, are like prices. The price of cars in terms of bread and therefore the prices of imports versus exports. So the concept of the price of imports versus exports determines how beneficial trade is. And this concept, this relationship, the ratio of export prices to import prices, is known as the terms of trade. So for example, if the 2 products here are exchanging in a ratio where for 1 car, the price of bread is somewhere between 0.25 loaves of bread and a half a loaf of bread, both countries will be happy. Remember, the UK wanted to get more than a quarter of a loaf of bread for each car, and China would want to be making less than half a loaf of bread to receive 1 car. So as long as the price of cars in terms of bread was somewhere in the middle, say 0.3, then both countries at this rate of exchange could benefit. This would be a suitable terms of trade. So the terms of trade is defined as the ratio between export prices and import prices. So what we do is we take indexes of all the exported products that we sell, create an index, and we divide by an index of the prices of all the imported products that we buy. And so we can calculate this times by 100 to get an index of the terms of trade. If we can see this from the maths, but if export prices rise faster than import prices, the terms of trade will strengthen. This is good for our economy. If the price of cars rises faster than bread, then the UK's terms of trade will strengthen. If import prices rise faster than export prices, the terms of trade will deteriorate. This will be worse news for our economy. So here's an example of the USA terms of trade. So we have 100, our starting position on the index here across the middle, and we can see that between 1992 and 2007, in this period here, the terms of trade was in the United States' favor, i.e. the value, the price of what they sold was greater than the price of what they bought. However, from 2008 through 2012, we can see actually the terms of trade deteriorated for the USA. The value of what they imported was greater than increased more than the value of what they exported. If we throw our net a little wider and look at another example here, a country like Zambia, and particularly developing countries, tend to be very susceptible. Terms of trade is very important to their economies. So if we look at this quote from the IMF, the International Monetary Fund report on Zambia in 2015, the historically high terms of trade and increases in FDI and copper production have been key drivers of economic growth over the past decade. But with copper exports representing 3/4 of total exports in 2014, Zambia is vulnerable to terms of trade shocks, i.e. the economy is very reliant on exports here, and therefore if the price of exports was to fall, this would cause a shock to the economy. And we can see that whilst export prices had risen for Zambia over a lot of the period, by 2014 we can see that copper prices in particular had fallen, which we would expect to cause a deterioration in the terms of trade for Zambia. So we can see that this little graphic illustrates that Zambia was a price taker in terms of copper. And so changes in the world price of copper would have a big effect on Zambia's terms of trade. So here is Zambia's terms of trade, and we can see that. We can see the index here decreasing as copper prices have fallen, and the index of export prices has fallen over time. So what would be the consequences of this steep drop-off in export prices for Zambia and a deterioration in their terms of trade? Well, number one is a fall in export revenues, leading to a fall in AD, causing a drop in GDP growth. Number two is that it might create a large current account deficit, draining foreign exchange reserves. Number three, as less people demand our currency, there's a depreciation of the currency, which may lead to cost-push inflation. We might see job losses in the mining sector. There may be a negative multiplier effect for other areas of the economy. The government is likely to experience a fall in tax revenues as the major copper mining companies reduce their profits. And there may be social consequences. Mining companies have subsidized HIV medicines within Zambia. So changes in a nation's terms of trade can have important effects on macroeconomic variables such as living standards and the competitiveness of producers in world markets. For example, an improved terms of trade might mean a nation is able to import cheaper food and energy, which then increases real incomes and living standards. A weaker exchange rate may increase the price of imports and worsen the terms of trade. E.g., it then makes imports of new capital technology more expensive. It's important not to confuse the terms of trade with the balance of trade. The balance of trade is the difference in the value of exports and imports, whereas the terms of trade is the difference or the ratio between export prices to import prices. So in this video, we've looked at the concept of the terms of trade. That's it. Thanks very much for listening.